En tiempos actuales, acompañamos a los distintos actores del mercado asegurador en la carrera por la transformación digital. Ser ágiles ya no es una opción. Mientras se enfoca solo en sus clientes, InBroker se encarga de todo lo demás. Es una plataforma diseñada para administrar todo tipo de riesgos dentro del mercado de seguros, desde líneas personales hasta negocios complejos. Permite a los bancos gestionar sus propios seguros. InBroker es un producto líder en la gestión de bancaseguros. Cuenta con la experiencia de más de 30 años siendo líderes en innovación tecnológica para grandes brokers, operando el 100% de su negocio. InBroker se integra fácilmente a su ecosistema de operaciones. Es el corazón de su negocio que late con una visión 360 grados, que impulsa su gestión de seguros hacia la innovación tecnológica.
La transformación digital nos inspiró a diseñar un portafolio con soluciones flexibles para nuestros clientes. Creamos un seguro de arrendamiento que se adapta a las facilidades del mundo digital. Diseñamos un seguro de auto que nuestros clientes pueden activar y desactivar cuando realmente lo necesitan. Los acompañamos en esos momentos inesperados por tan solo 123,000 pesos al año. Los protegemos ante posibles fraudes del mundo digital y cuidamos a cada miembro de la familia, incluyendo a los peluditos. Y lo mejor es que ahora nuestro portafolio podrá ser comercializado en Moon Digital, la plataforma que permitirá cotizar y vender todas nuestras soluciones. Somos tu compañía siempre, transformándonos en cada paso.
En Global Seguros tenemos soluciones para los que sueñan junto a su familia y saben que futuro es sinónimo de posibilidades. En Global Seguros encuentras la tranquilidad de proteger a los que más quieres. Nos comprometemos por ti, por tu familia, por el futuro. Empresa vigilada por la Superintendencia Financiera de Colombia.
En Experian creemos en el poder de la data para crear un mejor mañana. Capacitamos a los consumidores y a nuestros clientes para que administren sus datos con confianza. Ayudamos a las personas a tomar el control de su comportamiento financiero y a acceder a los servicios financieros. Ayudamos a identificar y transformar las oportunidades de nuestros clientes en negocios sostenibles. Potenciamos oportunidades y creamos juntos un mejor mañana.
Thank you very much. It's a pleasure to be here today. And as the introduction said, I live in this very strange space between one of the largest tech companies in the world and one of the largest reinsurance companies in the world. And from that perspective, I'm going to share what I've observed and a little bit from my experience on this question of what happens when big tech attempts to enter into the insurance business, and especially to redefine and transform that business using all of the elements of technology that have been so successful by these companies in other industries. The question arises when I thought about this, about what happens when very dissimilar industries collide, because that's really what's happening here. This is not a natural mating, although you would look back in history and say, why on earth have insurance sciences and technology sciences found a more compatible place to operate together? I'm going to talk a little bit about that. The issue of integration of these kinds of industries is all about how rapidly changing technology today can be expected to converge and create real changes and transformation in how markets actually work. And the idea that technology companies look at is, by that kind of integration, new utility and new value emerges. And we've all been part of this in so many other industries. The questions that arise about this are, do the industries themselves, in difficult places like this intersection, do the industries themselves change and transform, or is it just products? I'm going to try and talk about that today. Are new industries really created and old ones left behind? Or is this just separate and different industries figuring out how to leverage each other in separate ways for common value? I'm going to try and talk about that. Is this real convergence and disruption? Or is this just blurring of lines between industries? Or is it perhaps even something else? Now, I'm not an academic. I'm a business leader. In fact, I'm an insurance guy. I've spent most of my professional career in the insurance industry, and even within that, in the healthcare industry and the healthcare finance industry and the healthcare insurance industry. So I see a corner of what we see emerging as insurtech, but because of the magnitude and size of the healthcare spending in the world, this is a massive opportunity to raise the question, does insurtech really work? And if it isn't working right, what's it going to take for it to work better in the future? So I put 35 years into this. I have pursued technology as a means to transform the businesses I've been in. And I'll say that while I have seen technology help and assist and improve and make businesses function better, I've not seen the kind of transformation that we would expect. The years have produced progress, but quite a bit more in the way of disappointments and really a lack of fundamental transformation. When I talk to others, they say, the reason that's the case is because technology itself has only recently reached the place where this kind of substantial transformation can occur in an industry as odd as the health insurance industry. And especially when you look at the health insurance industry in the massive country of the United States, you see, even more complicating factors there as well. So I'm going to look at the insurance industry and consider what I know well, which is health insurance. I'm going to try and use this window into the insurtech movement that drives it. Who is impacted by insurtech? What are the challenges to new insurtech models when they're applied into health insurance? What is the way these new entrants look at this market? Why do they look at it? What do they think? What do they expect? Is it or is it not compatible with the way these industries work and the other existing players in the industry? And how are the other players going to respond? And then I'm going to refer to my experiences over the last few years as CEO of two insurtech businesses, one that was in the distribution business, the other one that was in a specialty medical care business, the chronic kidney care business. And then today, the business I'm in at the intersection of the largest life sciences affiliate of Alphabet, the Google company, and also the corporate services part of Swiss Re. So very, very interesting place that I come from to look at this. Context, I will talk about, again, how do I look at this, where my perspectives come from. Compatibility is an interesting question. The idea of insurance science and data science. I refer to these both as sciences because both actuaries and engineers would insist on it. And that in the world we're in, in the United States, we refer to this as health insurance, but it really has very little to do with health insurance. This is much more the way the rest of the world refers to it, which is really sickness insurance. And there's unique dynamics about sickness insurance. And in the world of technology, there are clear dynamics as technology companies look into health. So this question of how these come together and how does this world look to both of these industries. I also am going to talk about misperceptions and misunderstandings, especially as tech companies look at health care and health insurance. Here's a perspective for that. When an insurer looks to expand its markets, it starts with the question, what is insurable and what is profitable if it's insurable? So insurers are in a constant pursuit of scalability, but also stability in the process. Capital management, risk management, these are watchwords of people whose businesses in the insurance world. When a technology company looks at how to expand its markets, it starts in a very different place. It starts in the place of looking at inventorying what markets across the board, unlimited, what markets are not sufficiently penetrated by technology. And the technology they're looking for today is technology not as a facilitator, but technology as a driver. And that's how technology transforms industries. So we start with this idea that Insurance companies are looking at business and business expansion in a very different way than tech companies do. In fact, if we were to characterize tech companies, they're in a constant pursuit for, here it comes, repeatable, renewable, recurring revenue with low front-end fixed costs. Those are not necessarily the same dynamics of what insurance companies are looking for. Health insurance, even more so. Health insurance looks to tech companies like the largest or one of the largest per capita recurring subscription revenue products or services in the world. And increasingly, well, this is absolutely true in the United States, it's increasingly true in other parts of the world. We're going to talk about the competitive dynamics, what techs do to try and enter these markets, what the traditionals do to defend these markets, interesting play on each other, learning about each other's business, and figuring out how to mimic the other one in order to be successful. And then at the conclusion, my reflections of the conclusion are going to be really from the role I serve every day as the CEO of a company called Granular, which, as I said earlier, exists in the intersection between these two industries. So, context and perspective. I'm a 35-year veteran in business. I've had exposure to big tech. I've had exposure to big insurance. I've had exposure to venture, Insurtech, and what we used to call care tech. I spent 20 years as a veteran managed care executive. During that period of time, I dealt with disruption, not because disruption was going to be value creating, but because bankruptcy was looming us in the eyes. So this was a big turnaround. I was part of a turnaround team that took a company that was on the verge of being taken over in conservatorship by the regulator. That company is now the second largest managed care company in the United States. We were very successful because we never took ourselves too seriously, and we never took the core business of insurance too seriously. We always were looking for what can we do to increase values. Later in my career, I got involved with startup Insurtech companies, and there's a couple of them that are identified here. But I learned a lot about how venture investors think about technology and the intensity that they come towards this question of reinventing and redefining existing industries, and the reluctance of big insurance to be redefined. How deeply embedded they are in long historical norms and historic value propositions, and the struggles that come out of that. Now, in the United States, there's another confounding issue, and this plays out in my current role as CEO of this company, Granular. And that is that you look at what most of the world knows as a pretty messy system in the United States. Hospitals, professional medical clinics, independent physicians, employer-based benefits, which have this massive role in the U.S. healthcare financing system, consumer insurance, people who actually buy on their own, continues to exist here. We have whole different markets for the elderly, for the poor, for military, for unions, and on and on and on. And so it's a hodgepodge, well over $3 trillion, and probably more, increasingly working its way towards $4 trillion for a number of reasons that have to do with not just inflation, but government actions to continue to redefine and expand the definition of healthcare. These look to be the perfect opportunities for a major disruption from big tech companies. And we do see massive consolidation. Vertical consolidation, some horizontal consolidation, all the evidence of big opportunity, but these movements, these enormous capital investments in synergy have produced precious few real evidences of rationalization. Part of that's because these businesses are just so different. So I will talk a little bit about the differences. This is obvious to all of us, right? We all live in the tech world in our everyday life. We understand this is about things becoming more and more localized, more and more handheld, and behind the scenes are the tech platforms that make all of that work. Data flows up, data flows down, data moves into databases, data moves virtual, data moves beyond and among us, and other kinds of technology solutions make that that data, turn that data into things that we want and that we need and make it digestible for us. So the tech world is about things that are functional, that are tangible, that are can be connected very closely to consumer desires and wants, and the pursuit of what consumers either desire and want or they don't yet know they desire and want is what tech is all about. You get in the insurance world, it's a very different thing. And it's not as though we have different forms of food, for example. This is the difference between steel and bananas. In the insurance world, this is all about life cycles of human beings. It's very situational. So it's not about an answer for something somebody wants. By the time somebody wants something, it's too late to do anything about it. Insurance is all about having the awareness of what you want to be able to purchase protection. So if something bad happens to you, you get what you want, is to be made whole. And that's a very different thing. You're not buying the product, you're buying the protection for products you already have, so that if they disappear someday or are damaged someday, you get to replace them. These are very, very questionably compatible industries, and yet the whole Insurtech world is about creating compatibility between these very, very different worlds. Let's take a look deeper into what this means. In the insurance science world, the product that's being sold is protection from the use of things, right? I don't want to have a car accident. I don't want to have my house burned down. I don't want to have somebody steal my car. I don't want to end up with a dread disease. I don't want to die. And yet, if those things happen, the purpose of insurance science is to try and give me some form of compensation for it. So in some ways, insurance is about making right the things you really don't want. Now, when you look at data science is all about studying human behavior to make the things people really want more aware for them, and encourage them to actually purchase the things they want. Very, very different idea about what people want and what they get. Value in the insurance world is driven by price. Because I'm getting protection for something I don't particularly want to have, I'm incredibly price sensitive. Every dollar that I spend on it and I don't need feels like money that was wasted. In the case of data sciences and technology, it's all about value. If I get good value what I'm purchasing and I get utility from what I'm purchasing, I feel good about it. I might choose to actually do it again or do more of it. You look at the movement of handheld devices, of flat screen TVs, of smart appliances in our homes. People can't get enough of it. They take something that's perfectly usable and they replace it with something that is equally usable, but is much cooler and satisfies me in new and different ways. The culture around insurance science, culture, and by culture here I mean if you go inside an insurance company and you see what makes them work, what makes them tick, what is the management process in place there? It's a culture of certainty. You can't make mistakes. This is certainly true when you get into the areas of healthcare itself. The costs of a mistake or of lack of certainty are astronomical. But it's true also in the financing of care. People expect that when certain things happen, they're going to be made whole. And so this idea of certainty is very important. In the technology world, when you look at what drives them, how do they work, how do they manage, what's the environment they operate in, it's a culture of collaboration, of idea generation, of bouncing things off of each other. And so simply the idea of bringing these two together as companies creates huge cultural issues in the management of them. The nature of how value accrues. Healthcare is largely purchased by somebody other than the user. And this is true worldwide, whether governments provide financing for healthcare, whether large employers provide financing for healthcare. It's not that large provider or that government that's going to become the user of healthcare. And if they do, it's because the human being themselves that works for that government entity or for that company finds themselves as a user. Third-party purchases are problematic. The same kind of value judgments are not made when somebody else buys something for you or when they pay for most of what they buy for you. And so you tend to say, I want an unlimited amount of it because I'm not paying much for it. There's not a lot of trade-offs in terms of value. Value is price. and the expectation of utility is off the charts. When you get into data sciences and the products that are created in technology, they're highly focused on the purchaser as the user. So they're designed not only to satisfy the user, but to encourage the user to buy more of it or more of something highly related to it. So they're extendable. The businesses can move from one industry to another by simply taking the interest of a consumer from one to the other through the way the technology interfaces with the consumer. That would be devastating in the world of insurance. Data, which is a big part of how we think about both of these sciences. Data is compromised in the healthcare industry. It's been compromised because the interested parties modify the nature of data to get what they personally want. And so what we find is whether it's a government or whether it's a private industry, an awful lot of money is spent trying to uncompromise data itself. So it's as pure as it can be. And it's a constant battle of chasing after what could otherwise be clean indicators of health and healthcare needs and the price of healthcare and the amount of money that ought to be spent on healthcare and what the next course of treatment is, to try and make that real when those on both sides, those that are providing it and those that are paying for it, are trying to re-engineer it so that it has financial advantage for each of them. Again, we have data anomalies in all forms of technology, but the science itself does a pretty good job of starting to correct for the anomalies using advanced data analytics itself. Someday, hopefully, that will happen in health. Healthcare and health insurance are regulated. They're both regulated differently, but they're regulated for a purpose in the area of insurance. They're regulated for solvency, that you're going to be there when there's a demand. They're regulated for market conduct. Do you interact with those who depend on you in fair ways? It's not about the product. It's about your behavior in the market and your capacity in the market to do what you promise. In data sciences, yes, there's a lot of regulation too, and we know what that's all about these days. It's all about privacy and security protection for the consumer and for others. There's clearly other times when technology, especially in the Insurtech world, bumps into other forms of regulation. To the extent Insurtech is in the area of new therapies or in drug treatments, all kinds of new regulators appear on the scene, but those regulators are not the same regulators in most parts of the world that regulate insurance. Now we have product dynamics that are different between these two industries. We tend to think in the insurance world that our product is the insurance policy. That's what we've created. That's what we've priced. That's where our promise is. That's where the buyer is doing a commercial activity with us. And yet when you look in data sciences, there's nothing like that. The product is a piece of hardware, a piece of software, an analytic solution, or a solution that's a combination of all those three. It's very tangible, it's very physical, it's very experiential. Analytics exist in both of these worlds, but analytics in the insurance world are used increasingly to improve the way we create these insurance policies and to improve our ability to price them, to predict what they're going to do over time when real human beings experience them, and to improve the design for the next year so that it has a better financial outcome than currently. That's what analytics are all about. In the data science world, analytics is sometimes the core of the business itself. You may not interact with my parent company's largest business, Google, and think about the fact that you are interacting with an analytics product, but you are. You're just trying to get a question answered. But what's behind that is not something that uses analytics. It's analytics itself. It's deep data analytics brought back to you and compiled in a way that the question you're asking is answered. So we try and bring data science and insurance science together. If we're going to have transformation, these differences have to find compatibility. Big challenge. Doesn't mean it can't be done. And whoever does this, whoever can deal with these kinds of differences and bridge them is just going to be incredibly successful. So let me narrow a bit because I'm sure everyone here understands that there's all kinds of insurance in the world. There's about almost anything that has the possibility of going in a direction that you don't expect has an insurance opportunity associated with it. It's in all kinds of industries. It's for all purposes, all kinds of buyers, both consumer and enterprise. I want to work our way down to healthcare itself, because that's the business I spend most of my time in. And it's also the business where even the insurance model that we just went through and its differences are even more challenging. Here's a couple of thoughts on the challenges with health insurance. Healthcare is not really health insurance. When I buy insurance for my car, I'm buying an insurance for the value of my car itself. And so if my car gets stolen or if my car gets destroyed, the remedy is I get another car equivalent to the one I had before. And the whole science of the insurance, of car insurance, is to determine what the value of that car is, what I'm experiencing with it, what the replacement value might be, and make sure that if it's a legitimate loss, I get another one. Similarly, if I have insurance on my home, there's a value associated with my home and my property. And if there's a fire or an earthquake or a flood, all of which, by the way, we experienced in my hometown of California, if those things happen, the goal of insurance is to make me whole, either repair my home to the condition it was in beforehand or build me a new home. So what's being insured is the item itself. Insurance is different. Healthcare is not covering the value of me. It's not covering the value of the human being. It doesn't even attempt to calculate the value of the human being and restore that human being to the same value. What it's insuring is the actions that I may take when I don't feel good or when something happens to me. So the insurance is not about me. It's about the course of spending that I'm going to have to try and get me through this tough time of my life. So it's different. The other thing about it is healthcare occurs with us all the time. It's not something that I will put some money aside for today through an insurance policy, and 10 years from now something might happen and I get my reimbursement. Healthcare has been defined in such a way that people are consuming healthcare all the time. Things that are consumed all the time by most of the population are by definition not insurable. So I'm in the health insurance business by all real definitions of people who are true insurance people would say that's not even really insurance. That's just short-term financing. So it's another very funny thing when you deal about health insurance and health insurtech. An awful lot of health insurance is not insurable. Wellness is not really insurable. The idea is if I take better care of myself, I'll have less bad things happen to me. But the link between those better behaviors and an outcome 10 or 20 years from now are very poor. They're nowhere near as well developed as the link between somebody who smokes and the likelihood of them having an early death, where the science says we actually know exactly, on average, how many years that's going to take off your life. And we can build a policy that says we'll respond to that. Healthcare is in its infancy in taking things that are everyday expenses and determining that there is a sizable enough avoidance years from now to be able to include those everyday high-frequency expenses in an insurance policy. Insurance is typically defined by a lot of money, a small amount of money paid in by a vast number of people who are not going to use it, so that when the very few need it, the money is there. Much of healthcare doesn't work that way. And as I said, it's not like property, disability, or death insurance, and I went through some of the reasons for that. So we start with an even more confounding problem when we're dealing with health insurtech, which is clearly the largest opportunity from a dollar and cents standpoint in the world. Recurring price is subject to long-term systemic inflation. And there are reasons for this that have to do with societies that are aging, even though the workforce is not aging, right? So in some businesses, in some parts of the healthcare industry, we see simply the effect of aging and the very, very expensive cost of healthcare for the aging. In others, such as employer coverage, the average age doesn't go up, so that's not the big driver. But we also see that there is a redefinition of what healthcare is. That comes because there is an onslaught of new treatments all the time, new drugs all the time. And almost without exception, new treatments cost more than the old treatments. They're more effective than the old treatments, but if you were to put a dollar and cents comparison between the dollar value of the improvement in health outcomes by expensive new treatments compared to the not quite as effective outcomes of the older and less expensive treatments, they don't turn into an economic improvement. They turn into a social and political and personal improvement in life. So the end result is there's built-in inflation into healthcare. And we've got something that's already incredibly expensive. That inflation, is just multiplied by that. The same is sustainability in many parts of the world, certainly in the United States, of healthcare financing through employers and others, is dependent on, incredibly substantial tax preferences for an employer to provide a worker with a health coverage policy as opposed to just more cash. Now, in the world we're all in today, where governments are spending incredible amounts of money they don't have, and international debt of sovereign countries is exploding, sooner or later, this kind of government funding without any source of income to offset it will be questioned. And so there's big questions about what will happen in the United States if employers no longer had basically tax-free treatment for what they provide to their workforce. So again, this makes health insurtech uniquely challenging. So I thought it'd be fun to talk about misperceptions and misunderstanding in terms of buzzwords and keywords that are popular in the tech industry. I hear these all the time because I sit, as I said, between one of the world's largest tech companies and one of the world's largest insurance companies. So I have to perfect lingo in both, even though my whole history is from healthcare lingo, but I find it fun. We hear the use of data constantly. I think of information as a big part of how how insurance is made to work, but information is generic. To tech companies, it's all about data. Data has a specificity and an accuracy expectation about it that is unlike the things we see in health insurance. And so it's a term of confusion. The use of data and information interchangeably, the expectation that we can define and collect every single piece of information associated with somebody's insurance needs or insurance fears, or even their personally close held secrets about their coming health, insurance or healthcare needs, right? We believe we can get to all that by just mining enough data. And that may turn out to be true. It's very, very hard to imagine something this intangible yielding to that, but it is a big part of the way tech companies think. The idea of delight, which I always chuckle about, and how we score delight. Starting with this MPV scoring of what we used to call in the old days satisfaction, or even value of services. But the idea is that there's a much higher bar put when a tech solution is brought, especially to a consumer, but even to an enterprise, that it's not enough to say that service was great. It is not enough to say I was fully satisfied. It's not enough to say my satisfaction level was exceptional. The term of understanding is that I was delighted. And that is a high bar for something as emotional as my health and my life. And that I should come to understand that at the time that I'm going through potentially very tough and life interfering treatments for disease, for accidents, for other things. But this is the high bar, this delight idea. Can we find in a business like insurance an equivalent to delight, or can we even find delight? That's what the tech companies are seeking. There's also concepts of confusion, not just terms, but concepts. We have this idea of engagement in the insurance business. Engagement might very well be receiving an invoice and paying your premiums on time. Engagement might be that you call because your claim took too long to pay. And engagement is often tense because a an expectation was not met. In the tech world, engagement all happens before the fact. It's all about, I have brought something to you you didn't even expect, and as a consequence of that, you're going to be so delighted by it that you're going to start engaging on a handheld device or on some other piece of hardware or on some software or through some game or some game-like interaction. And the engagement is not what you do to solve a problem. The engagement's actually the value, right? It's actually the thing that tech companies seek more than anything. Not that people will engage in a product, but that they will engage, because engagement is the expected result. And so that's why I have engagement and product so closely linked here. The product for a tech solution is all about the experience. The product for an insurance company is the interrelationship between a policy that you purchased, your understanding of that policy value, and your experience with whether or not you got the value you expected out of that policy. Very different, very real, very real. This is the point of emotion in both sides. And then finally, we have actually expectation confusion. Not only do these things exist in our language and our concepts, but by its very nature, we set expectations that are contrary. So in the insurance business, we don't think about enterprises, we think about employers. We don't think about consumers, we think about subscribers or members or patients. These ideas of consumer and enterprise dominate the language for tech companies, because their whole question is, do we distribute directly to consumers, or do we distribute directly to enterprises, or do we even distribute directly to enterprises for purposes of the enterprise making this available to a consumer? We have different terminology and concepts for that. In insurance, one of the big examples of moving through an enterprise or an employer, in that case, to a consumer or a patient is the whole movement of voluntary benefits. It's created by the insurance industry to say, I have a relationship with an employer, but I'm not sure that employer, in the way their coverages are structured, have a way of meeting individual specific needs of their workforce. So how about if I talk that employer into giving me an avenue of conversation and offerings directly to their workforce? And so we've seen all around the world, and especially we see this in the United States, supplementing health coverage are these voluntary programs that offer cash if certain things happen. And the consumer likes that, because now we've returned this to something a consumer understands, which is price. I'm going to give you money if you get admitted to a hospital. I'll give you money if you get diagnosed with a disease you didn't expect. And we're going to write you a check. That's now money you can use for the things that you determine to be important. That's a lesson for us in Insurtech too. This idea of looking at what occurred in the voluntary insurance market as a model for how we move technology and technology's value system into insurance products that are sold to employers, governments, and sometimes even consumers. There are financial terms like gross margin that that everybody in retail businesses, manufacturing businesses, as a matter of fact, pretty much every business understands. You've got revenues, you've got cost of sales, and then the difference between those two is something called a gross margin. That sets sort of your fixed margin, and then everything below that is what does it take to distribute it and service it before you get to your profit. In the tech world works just like that. And their whole value structure is about how big can you make that gross margin? Because they're building a platform. That platform is only built once over a fairly large period of time, and then you're just pumping people through it. So very, very large gross margins. And as a consequence, they can spend enormous amounts of money on marketing, sales, and communications, and expansion. It also means that they, as a result, have very high multiples, very high profits. In the insurance world, that gross margin, the closest equivalent to it is something called underwriting margin. It's the difference between the revenue or the premiums that are paid by an insurance policy and the direct cost of servicing that policy. The payment for the car that had to replace the stolen car, the payment for the house to be rebuilt because it was burned down, the payment for the transplant surgery that I had because I got very sick and somebody had to do that surgery on me. What's left after that is the underwriting margin, and it's a very different profile of the expenses than to service it. There's very little left for traditional marketing. It costs a lot of money just to service the policy for me to get that money flowing. Also, governments have started defining what the relative share of these underwriting margins ought to be. In the United States, in 2009, the Affordable Care Act was passed, and by 2014, every health insurance policy in the United States was subject to underwriting margin that can't exceed a fairly high number. And so the ability to make profit is now all about controlling administrative costs. A tech company wouldn't look at that way at all. They'd say, no, it's all about optimizing, maximizing value, and that occurs by expanding the underwriting margin. The other thing that expected confusion is tech companies' first view when they look at a complicated, morass like the health insurance industry in the United States, and they say this industry is characterized by unnecessary players. What we got to do is use our technology to disintermediate the unnecessary. And while in time they may be exactly right, that is a good way to get yourself completely blackballed by the industry. And the industry is controlled. It is dominated by those who others might regard as intermediaries. So these things create real opportunities for language, concept definition, and strategy that allows us to use what's knowable and learned and apply it to this new Insurtech world. I want to be mindful of my time here. So what happens? Techs persist. They say this is all about platforming. They saw Haven coming a mile away from Amazon and the other companies, and they didn't allow a space there. They probably see us coming from the alphabet companies and Swiss Re in a new form with a whole new dynamic on how technology can be used. They don't necessarily make a space for us. The first thing they do is they shut off access for data. But they also say, wait a minute, we've got to reinvent things we do. And we can't be sleepy as tech companies, assuming that traditional insurance companies are going to just let this happen. And so they're investing in technology of their own, especially in the areas of distribution and through their areas of distribution to support their own value chain with their own technology. Disruptive analytic tools and advanced insight. This is probably the greatest thing that tech companies will eventually bring if we can figure out how to package it right. But what insurance companies say is those things are not best suited to creating delight with consumers. A company named Oscar learned that. Oscar, a few years ago, raised an enormous amount of capital at a very high multiple, and their value premise is we're going to take advantage of this new Affordable Care Act, and we're going to come out with a more consumer-friendly version of individual health insurance. And they did. And it was packaged well, and the communications were very different than the kinds of things you get from an insurance company. When you received your welcome kit, it felt like you were receiving an iPad. But when it was all said and done, they were still selling an insurance policy. And so they've had to struggle with the dynamics of making the insurance business work a little bit better than everybody else's, because they win, if you remember my point, only when their price is competitive. And so while these things are fabulous, they're just fabulous and fun, they aren't going to make the day with the buyers of insurance. Alternatively, the insurance companies realize that if they can improve the real analytic engines of what they do, their underwriting departments, their underwriting algorithms, their ability to issue policies quickly and efficiently and move customers and customer experiences from one unrelated function to the next. If we can make these transparent and seamless, those are good ways of using data. And then finally, how do you report back on the outcomes and the things that occurred? Tech companies know a lot about how to create interesting and engaging feedback. And from the insurance world, we all have a lot to learn there. Finally, tech companies look at the industry and they say, my gosh, this is a morass of point solutions. There's, for every kind of care, there's somebody who says, I do that kind of care better than everybody else. And it's because the natural breakdown of giant monolithic companies over the last 10 years is the proliferation of small point solutions. They're all over the place. And it looks familiar to tech companies. It reminds them what happened during the dot-com boom. And the question is, who's going to be the survivors? And can we invest in the survivors? And can we roll them up? And can we create solutions that are going to be the winners? And this may occur, but there's a lot of these point solutions out there. And what has happened is insurance companies have said, well, if that's the case, let's see if we can help with the movement to unbundle traditional services in ways that we can create the best-in-class collection of those, understanding the underwriting and health-related or life insurance or disability-related importance of each of these point solutions. Excuse me. Finally, selective responses to commercial and government actions. Techs are going to miss this. They're going to misunderstand that this is a radically changing environment because governments are not stopping and they're making a lot of changes. But the problem is that traditionals are not jumping into it either. What traditionals do is they jump into the lobbying work, they jump into the government affairs work, and their whole goal is nothing should change. The right answer is going to be whoever comes into this and says, no, the right answer is to take these trends and come up with a way of leveraging those trends in ways that redefine these markets. Excuse me. So let me conclude. The company that I work for, as I've said, is an intersection between a very, very large tech company and a very large and old insurance company. And we came into this saying that if we're going to be successful, we have to not fall into the traps everybody else fell into. We got to come into this not thinking like an insurance company and not thinking like a tech company, but instead think like a company that's trying to operate at the intersection of those two. So what did that mean for us? 4 or 5 key points. We needed to create a thesis about what an alternative insurance model would look like that takes advantage of technology in new ways. And the idea is it had to have a unique story and it had to have unique hooks so that the market for insurance products would say, wow, that's different. And we did that. We came up with a single entry point. We have that was designed around that premise, and we have 3 or 4 we're launching next year that are designed around similar thinking. Second, we said we have to mimic the market that we're entering. We can't come up with something that's radical, given how controlled access is to this market. And even though people will talk to us all day long about our great creative ideas, no one's going to buy unless you're selling what they're purchasing. And so we had to say we're going to mimic the market and enter the market in somewhat traditional looking ways. And then as we build relationships, because this is a subscription, annually renewable type of business, we increase the depth and concentration of the values that we're going to add each renewal. And we build these deeper tech-like relationships with enterprises and with consumers by virtue of this occurring over time naturally in the cycle that insurance operates in. Number 3, build that pathway for transition over multiple years and multiple renewal cycles. And so we've had to do some real long-term thinking. As an insurance company, we've had to think about pre-pricing some things that may not occur for 2, 3, or 4 years. That's unheard of in the health insurance world, to put guarantees up front for things over that extended period of time. We have to be constantly aware that we have to increase value and value sharing with our partners along the way. That is not a remote idea for either a tech company or for an insurance company, but we have to do that in ways that reflect both. And then finally, the hardest thing of all, and I just mentioned it, is take upfront risk for everything we're promising. Buyers of health-related coverage don't take, they will not buy something that you say, this is going to work and here's why, if the buyer has to run the risk that it'll work or not. So using insurance as the mechanism to say, I will price the guarantees up front, I will guarantee this over multiple years, and if it doesn't happen, it's my problem, not yours. That is the most complicated thing we do, and it is probably the most important part of how we have linked our strategy together at Granular between insurance and technology. So I'm going to stop there and open it up for questions.